Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. I'm Brian Greer, but just to provide you kind of a quick introduction, if you're not familiar with our organization, we do focus exclusively in the sales tax arena. We do a lot of consulting type of work, so Jeff heads that up for us. And what I mean by consulting, we end up addressing questions related to nexus, sales tax exposure, voluntary disclosures, different options to mitigate sales tax risk. We help companies in that area. And then we also provide a compliance outsourcing service where we essentially become an outsourced sales tax department for our clients and prepare and file the various monthly sales and use tax returns for the clients. I kind of fast forwarded here to the agenda, so you've had a few minutes to kind of digest that, but we're going to initially look at some opportunities to identify and determine the sales tax risk and exposure. Again, thinking that probably most of the attendees are with firms, so it kind of has a focus on identifying and determining that exposure with your clients. But certainly if you're in industry and representing your own business, all of these same thoughts and concepts apply to you as well. We're then going to look at some of those mitigation options and strategies. I referenced the VDA piece before, but we'll talk about voluntary disclosure agreements and different mitigation options that are available to you. And kind of throughout this, we've got a few specific real world examples that we'll weave into the discussion as well. And then we'll kind of wrap up with a short piece on just the ongoing compliance aspects and how to set up a compliance process.
This is Jeff Meggs, and I'm going to talk a little bit about kind of what we typically do when we're looking at a new business or even an existing business, sometimes even an older business who hasn't quite grasped their requirements for sales and use tax purposes. As Brian said, kind of the set the stage for you here. We all have been in different circumstances at different times that were more favorable than others. Where you don't want to be is in the midst of a potential acquisition, or you don't want to be representing a client who's in the midst of a potential acquisition. And during that acquisition process, due diligence uncovers a $2 million sales tax exposure, and it turns into a fiasco relative to cash, relative to requirements to get the deal closed. There's typically an escrow situation that's involved. And in some cases, we have seen deals collapse because of the sales tax component or the sales tax risk and exposure. And it collapses for one of a couple of reasons. It could be that the seller just has no ability to mitigate the cash and can't stomach the hit to the purchase price. Or it could be that the buyer sees it as way too much risk and complexity to bring into their current business platform or model. So the idea is we just want to be prepared for the eventuality of something in the way of an event that could be an equity event, or maybe it's just preparing yourself for an eventual audit. Either one can have some negative financial impacts. The first thing we do, as we focus our business is focused on small to mid-sized companies, and we work with companies throughout the United States as well as internationally. The first question we like to ask is around nexus. Nexus being a connection that would allow a taxing jurisdiction to impose its sales tax on the business. Without nexus, there's really nothing to worry about, generally speaking. So we tackle that first because it's usually fairly easy to make a determination around. But I'll talk a little bit about some of the history around it. From a sales tax perspective, nexus has historically been associated with a physical presence. That would be having an office in the state, having employees in the state, maintaining an inventory in the state. And for the better part of 55 years or so now, we've kind of operated under that premise. The last 5 years of that 55, we've kind of been in a unique perspective relative to an economic standard. So both the physical presence standard and the economic standard exist today. And one of the things that we would commonly see with regards to the physical presence test historically was companies not recognizing by sending employees into a state temporarily to solicit or leveraging third-party contractors within a state to perform some aspect or element of a service. Those can trigger nexus, physical presence nexus. And so there's historically been a lot of confusion around that. The other thing that was difficult sometimes from a physical presence test was that there weren't a whole lot of granular details available from each of the states to say, how many days can I send a sales rep into the state to solicit? How many days might I be able to visit the state, perform some training before I'm actually considered to have established nexus? And so there was some ambiguity around that. For the most part, we kind of adopted a fairly reasonable approach, somewhat conservative, that said if you've got 3 or more days of activity in a given 12-month period or within a calendar year of either solicitation or services, we would say that if the state had that information, they're more than likely to assert nexus. Now, the other thing about nexus that I want to point out is nexus doesn't mean you have a tax responsibility. It doesn't even mean you need to register. So just because you've reached the threshold of nexus, whether it be physical or economic, doesn't mean you have to do anything. There's a step-through process, and we'll talk about that here in just a minute. So I referenced in the last 5 years, we've operated under a combined physical presence and economic nexus standard. A lot of you are probably familiar with the Wayfair decision, it being as mature as it is now. All of the states have what we refer to as an economic nexus standard or legislation. And when we say all of the states, if you're not in tune with a lot of the sales and use tax rules, there are 5 states that do not have a state level sales tax. Those states being Oregon, Delaware, New Hampshire, Montana, and lastly, Alaska. Now, while Alaska does not have a state level sales tax, they do have city level sales taxes. These are taxes that are ordinances developed or established by cities within the state of Alaska. They administer their own sales tax and they have their own taxability. So once this economic nexus standard was approved by the Supreme Court back in 2018, all of the states, again, legislated their own standards. And the standards are essentially $100,000 in gross receipts in a 12-month period or a calendar year. Now, having said that, and this will kind of be a theme probably in other parts of the presentation today, there are always exceptions to the rule in sales tax. There are always nuances. And so what I communicate to folks when I'm trying to talk through how to think about nexus, I talk about those physical steps or those physical standards. And then when I talk about economic standards, I use that $100,000 threshold. And it's basically when you've invoiced $100,000 to a company or a customer within that state, within a 12-month or calendar year period, you should start now asking the question, have I reached the nexus threshold? So the nuances would be states like California and Texas, where it's a $500,000 threshold. Mississippi and Alabama have a $250,000 threshold. The other nuance that exists out there is a number of states have transaction thresholds. And so you could either be subject to a revenue threshold of $100,000, or if you've exceeded 200 transactions in that same period of time, whether or not you've met the $100,000 threshold, you will have established nexus from an economic perspective for sales tax purposes. And these nexus rules aren't necessarily transferable to the income tax world, so we're not making that connection here. And frankly, my perspective is it doesn't from an economic nexus perspective, although I think there are some elements of evolution that are happening on the income tax side from an economic nexus perspective. So again, the first step to our analysis is, does the company have nexus for sales and use tax purposes? Yes or no? If the answer is yes, we then ask the question, what are we selling into that state? Whether or not our products or our services are taxable for sales tax purposes is really the key ingredient. And in the overwhelming majority of the states, really all the states that have a sales tax, their statutes will basically start out with the sale of tangible personal property is subject to sales tax. Then they'll evolve or have evolved into enumerated services. So depending on what type of service it is or how it's delivered, it too might be a taxable event. And so more so than even nexus standards, there's a lot of variability across all the states relative to taxability of products and services. And not just that, there's also applicability determinations based on the users of those tangible personal property or services. So just because tangible personal property is subject to sales tax, when it's sold to Walmart in a capacity where Walmart's going to put it on their shelves for resale, it's actually exempt for resale. So when I sell to Walmart as a major distributor, Walmart will give me an exemption certificate, and then I'll be able to exempt that transaction from sales tax. Some other exemptions that are fairly common would be nonprofit organizations, state and local governments, although not all states allow for nonprofits and even state and local governments to be exempt from sales tax. So you want to be careful not to apply that across every state. And lastly, the federal government, supreme immunity from anything and everything, but they are excluded or exempt from sales tax. There's no need to provide any exemption certificate or proof of that. If you sell to the federal government or an agency of the federal government, it's exempt. The lone exception to that rule is the state of New Mexico. I'm not going to go into it, but I'm just going to leave you with the fact that there's a potential issue in New Mexico, potentially exposure there if you're selling to the federal government and not charging tax. When we look at the services that states have evolved to taxing or pulling into their tax base, services, again, can come in a lot of different flavors. A lot of folks like to talk about professional services being exempt, and it's not an incorrect statement, but it's not always accurate either. And when I say professional services, I tend to identify them as one of five things. Either it's accounting services, legal services, medical services, architectural services, or engineering services. Those are what I call the key professional services. And as you can see from each of those, there's specific education and licensing requirements to be able to operate in those capacities. You then can kind of stretch professional services into consulting. A lot of what I do is consulting. There's a lot of software companies that also provide consulting. So I tend not to put consulting into the professional services element. I always want to drill down on that just a little bit more granular to show that it is in fact not taxable. Technology companies, I would say, find this to be the most challenging part of their exercise of taxability determination. There are customarily a lot of services, whether it be installation services, configuration services, programming, special programming, custom programming, training. There's a number of things that are happening in conjunction with the sale of technology. And it could also kind of follow suit with hardware as well. But there are nuances from state to state that catch people by surprise a lot of times. And the last one that's probably the most onerous is telecom. Telecommunications is taxed or is regulated to a degree like really no other industry. So it's fraught with danger. If you're in a telecommunications business or you have a customer or client that's into serving in a telecommunications capacity, they likely have either already adopted some pretty significant compliance methodologies or processes, or they're probably going to need to very soon. As we talked about nexus and taxability, those are things that we should be doing with our clients or within our own businesses somewhat consistently and regularly. It wasn't something that had high visibility prior to the Wayfair decision back in 2018, but in today's economy, $100,000 is nothing. We can get there very quickly, and so it's brought this to the forefront, and that's the management on a proactive basis. We're going to talk a little bit now about what to expect under due diligence, and we're talking primarily about whether it be a private equity or just another company that wants to consolidate operations and there's a merger. The buying entity, the surviving entity, generally is going to have some sensitivity to sales tax. It depends on the industry. Some are more prone to it than others. But what we find to be the typical scenario is that the buyer or buyer's representatives, they'll bring a third party into that equation. And they'll do this for all tax types and all business activities. And one of these aspects is sales tax review. And they're basically just looking to mitigate any risk or identify any risk that needs to be mitigated. The third party in this case is totally in the pocket of the buyer and is focused on mitigating their risk without any sort of consideration for materiality, without any consideration for reality in some cases. And I'll talk a little bit about what I mean by that. I already said that in the majority of the cases, if there's material risk in the sales and use tax arena, it's very unlikely the buyer's going to assume any of that risk. It's either going to be something they reduce the sales price for, they may escrow for it, or they may force some other mitigation option. And the other thing that would happen, and what we would experience, is that the third party that's doing the sales tax analysis is not in a position financially to go down into the depths of detailed invoice transactions. So what they'll attempt to do is look at the overall revenues of the business. They'll break them down into relevant categories, and then they'll apply some applicability test to those activities based on the amount of revenue to each state. And to the extent that a particular category is taxable in a particular state, the assumption is going to be that there's risk there if there's not evidence of compliance and good, clear evidence that invoices had been taxed and that the GLs had been cleared of those tax accruals. The types of things that are missed during due diligence are sales to exempt customers, whether that be because the customer is exempt statutorily, like I described the federal government being, or it might be that they're a wholesaler or a reseller and have the ability to issue some type of exemption certificate. The other thing that can happen is there's a lot of misinterpretation. Again, it's because these are high-level due diligence efforts. They're really not detailed. So there's a lot of misinterpretation of categories of what the true object of the service element might be. And so it happens that a lot of services get grouped into a taxable category in error. And the last thing would be, as they're estimating the level of sales and use tax risk, they're also estimating using rates that are general in nature. You know, in every state we see a state rate, and in a lot of states we see also a local rate. Local rate could be a city rate, a county rate, a district rate, all of the above. And so they're not going to get into the level of situsing determination on each of these revenue segments or categories, they're just going to apply a flat, consistent rate. And what can happen, and this happens particularly in technology as well as telecom, there can be some really unique rates that apply specifically to a certain type of product or service. For example, in Connecticut, SaaS sold for business use, instead of being taxable at the full state rate of 6.35%, is only taxable at 1%. In Texas, software as a service is taxable, but 20% of the charge is exempt from tax. So there aren't a whole lot of those examples out there, but there are enough nuances, and they happen to be sometimes in states where it's a fairly material impact. Another scenario that can happen is you might have a large revenue sourced to a state like Colorado. And in Colorado, what we find is that there's a state level Department of Revenue and Tax Administration. And then there are city levels, similar to what I described in Alaska. There are cities throughout the state of Colorado. There's about 70 plus of those that we refer to as home rule cities. These are cities just like I described in Alaska, have their own ordinances, taxability, and administration of sales tax. So the city of Denver, for example, taxes software as a service, while the state of Colorado does not tax software as a service for sales tax purposes. So there are just a number of nuances, and during due diligence, they're most of the time ignored. They're kind of brushed. It's a pretty broad brush stroke of application of the rules. So what happens is there's a report typically generated by that third party in the due diligence effort sent to the seller, and the seller is asked to answer those factors. In a lot of ways, there's opportunities to reduce the magnitude of that exposure just by providing some of those exemption certificates we talked about, or by illuminating some of the realities, the underlying realities and facts associated with a particular category. And I'll try to talk about a few examples of that here. We had a client that was operating in the state of New York, and they were providing some troubleshooting services. And in today's environment, they mostly would do that in a remote fashion. But this was a few years back, and they were providing on-site troubleshooting. And this was troubleshooting of technology, and it could be either software troubleshooting or hardware troubleshooting. And New York has some really specific laws. If there's remote troubleshooting services provided, they're generally not taxable. However, if you physically touch the equipment of the customer and the performance or provision of that service, it changes and flips to taxable. So we had a client that was invoicing their customers. The invoices themselves looked very benign. The language used on them, the way things were described, did not appear to be taxable events. Our client was not taxing those products and services. And lo and behold, they ended up being audited by the state of New York. And when they provided the information to New York for the audit review, they actually provided the actual paper copy invoices. And stapled to each of those invoices was a trip invoice or trip detail that detailed the actions and activities of the actual employee, saying that they went on site and physically touched the equipment. And it just changed the complexion of the entire audit. They were assessed about $880,000 on that particular issue. And they just had no idea of the rules, but at the same time, there wasn't adequate forethought and sort of analysis done to try to prevent something prior to the audit starting. This isn't an audit discussion, but due diligence is essentially an audit, just at a higher level at a different point in time. The other problem with due diligence is an audit typically is only for one state. Due diligence is looking at everything across all states. So it's a pretty broad picture. So now that we've received this report from the due diligence party, we have some potential options. As I already described, there's options to reduce the amounts by just providing more granularity, more facts. But then you get to a place where it's a number that can't be further reduced. And it becomes usually the authority in what's going to happen next is with the buyer. They kind of dictate. But you're not always going through due diligence. You're not always selling the company. It could be that you're just doing a review of your existing client, and you do discover there's some risk there. There's some prior period exposure. So what might we be able to do? Well, in some cases, you could take a more direct approach and just go ahead and register, indicating that you did start business 3 years ago, 2 years ago, whatever the circumstances dictate, and you had some taxable sales. The state will set up your sales tax account. If you did indicate you started business 2 years ago, they will expect and demand returns from the point in time in which you started business to current. And so it's really an effort to, you want to have a clean slate with the state, and this does accomplish that. If you don't have significant or material liability, this approach is not that bad of an idea, but it tends to take a lot of resources, a lot of time and energy to execute, and usually it's really not worth that energy. There are more, I think, efficient ways of doing it, particularly if you've not collected the tax. So in the case where you've collected tax in the past, that's got to get paid immediately and as quickly as possible. You just can't hold on to it. But instead of going back in time to file prior period returns, you might also opt to simply register and comply prospectively. Now, when you do that, the registration form is going to ask, it'll have a question on it that says something to the effect of, when was your first taxable sale? When did you start to engage in business in the state? Something along those lines. When we're working with companies that have not been in compliance, we typically will go forward and say, look, we're now identifying ourselves as needing to comply. So the date of compliance is June 1st or July 1st of 2023, and we're going to get registered and start to comply from that point forward. If I did collect some tax in the past, and if it's immaterial, we're talking in the hundreds and maybe low thousands, might be a good idea to just go ahead and register prospectively and pay those in on the first return. But you will be at risk for penalties and interest associated with those dollars that were collected in the past, and you could be hit with delinquency return type penalties because you didn't register earlier when you had the requirement. But again, it becomes a business decision, cost-benefit analysis. And lastly, we have the voluntary disclosure agreement, what we refer to as the VDA. And those agreements or those programs are available in every state in some form or fashion. Most of them are fairly consistent. But the voluntary disclosure agreement process is just another way to mitigate prior period exposure. And you go through a formality of requesting participation in the program, ultimately identifying the entity, and then there is some level of disclosure of the tax, payment of tax and interest. Usually the penalties are waived under a voluntary disclosure agreement, but it's not always waived when there was tax collected. Now, considering a lot of different factors, I want to talk just a little bit about when is the VDA the right thing to do, and I've kind of given you some of the high level or hints around that as well. If you aren't exposed beyond 3 to 4 years, probably not a good idea, probably not worth the investment. VDAs are expensive. You can do them yourself. Most companies will utilize a third party, so we do a lot of VDAs, so there's some fees associated with that, and you are coming out of pocket for the tax and the interest. More often than not, probably 90% of the time, our clients are not able to recover that tax from their customers, or they don't want to. They don't want to air their dirty laundry out to their customer base, so they just eat it. So it's expensive in a lot of ways. But when you're looking at the VDA process, we have had circumstances where a company was active 7, 6, 5 years ago in that particular state. They had nexus, they had material revenues, but then their revenues went way down. So their activities in the last 2 or 3 years have been fairly low. And under those conditions, it's a really good idea to do a VDA because you're disclosing a very small amount of material exposure, and it's not costing you that much, but you're getting that huge win of cutting off that earlier 7th, 6th, and 5th year of exposure and liability. So there can be some real value. The other scenario that can really benefit is when you've collected the tax. Now, there are different rules in different states. There are some states that they'll impose a small penalty. Florida will impose a 5% penalty if you've collected the tax and you go through their VDA program. Some states won't even let you go through the VDA program if it's collected tax, if you're a resident of that state. So but under normal conditions and in most states, if you've collected a material amount of tax, I've got a client right now that has 5 legal entities. 2 of those legal entities collected a material amount of sales tax in a given state. They need to do a VDA to get that tax disclosed, paid, and try to move forward without any further risk. And then, as we've talked about, you're going to find the value of the VDA both financially and strategically. And if you are in a position where you're staging the business to be sold at a particular time in the very near future, you generally want to consider a VDA or other mitigation options.
When we're working with clients and we're going through these scenarios of identifying exposure and how to mitigate it, and the conversation at some point turns toward, well, how are we going to manage this process prospectively in terms of, charging the applicable tax and getting everything invoiced properly and reported to the appropriate taxing jurisdictions. And when we look at setting up a tax calculation process, there's a lot of different options available for your clients and for you individually. But we usually look at a couple of different factors or variables in terms of how do we guide clients down the right path here. And we've talked about the taxability of the products and services, of course, understanding where you have nexus. But when you get to a spot where you're actually calculating the sales tax, you need to understand the taxability of that product and service in that particular destination or jurisdiction. What's the applicable tax rate? And you see, probably for the first time in this presentation, sidicing. Sidicing is, we're referring to where is the location of the taxing act, for lack of a better term, but where does tax apply? So if we understand the location, the taxability rules, and the rate, that's what we need in order to determine and calculate the applicable sales tax. So depending on the client, this could be very, very simple, or it could be extremely complicated. So you could have clients that have very few invoices. They could be in a very limited number of jurisdictions. Maybe it's a business that has significantly large transactions but very few invoices, where this process can be managed quite effectively, I'll say manually, just by understanding the taxability rules and the location. It's fairly easy to apply sales tax to a handful of invoices each month. And then you could have customers that are operating on a nationwide basis that have complexity with the types of products and services they're selling in terms of whether they're taxable or not, thousands of different tax rates across the country. That's a very, very complex scenario that you're not going to want to manually try to figure out how to do that. So when we look at those types of scenarios, you start to look at, the accounting system itself, and depending on the accounting system, some of those are going to have very good capabilities of managing sales tax just natively within the accounting system or even within the shopping cart. And then you're going to have scenarios, especially as you get into those more complex invoicing scenarios, where the invoicing system, the shopping cart, just is not going to be able to manage that effectively. And you're going to need to look for some type of third-party sales tax calculation solutions. A lot of you are probably familiar with some of those, including Avalara. Thomson Reuters has a tax calc solution, Vertex, TaxJar, Those are some of the SureTax. Those are some of the more prominent sales tax calculation solutions. So we start to look at implementing or tying one of those types of software solutions into this process in those more complex examples, and then leveraging just the accounting system or a tax rate subscription in those less complex invoicing examples. Thank you, everyone. Bye-bye.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.